Look, I need you to understand something that's happening right now. In exactly 3 days, we're going to look back at December 2024 and realize it was the last moment, the absolute final window, when gold was still accessible at these levels. And I'm not being dramatic. The data is screaming at us. Gold just closed at $4,124 per ounce. That's a 67% gain this year, the biggest annual surge since 1979. Let that sink in for a second. 1979. You know what happened after 1979? Gold went parabolic. It hit $850 in January 1980, which is over $3,000 in today's dollars. But here's the thing that's keeping me up at night. We're already past that inflation-adjusted level, and the fundamentals driving this move are 10 times stronger than they were back then. 3 days from now, we hit December 20th. And on that date, something shifts. The institutional money that's been sitting on the sidelines waiting for year-end, waiting for tax considerations, waiting for budget approvals, all of that money starts moving. January is historically the strongest month for gold, but this isn't a normal January setup. This is a January where gold is already at all-time highs, where central banks just bought more gold in a single year than any year in recorded history, and where the technical setup is pointing to a breakout that could take us to $5,000 by spring. Morgan Stanley just came out with a forecast. They're calling for $4,500 by mid-2026. JP Morgan went even further. They're expecting average prices above $4,600 in Q2 with a peak above $5,000. These aren't gold bugs. These are the most conservative institutions on Wall Street. When JP Morgan tells you gold is going to $5,000, you need to understand what they're really saying. They've already positioned their clients, and now they're telling everyone else, so the move accelerates. But let me take you back for a moment, because you need to understand how we got here. In 2020, gold hit $2,070. Everyone thought that was the top. The mainstream media was calling it a bubble. Gold has no yield, they said. The economy is recovering, they said. And then gold pulled back. It spent 3 years consolidating, building this massive base between $1,800 and $2,000. Every time it tried to break out, it got smacked down. The paper markets, the COMEX, the futures traders, they kept a lid on it. But something changed in 2023. The central banks stopped playing along. China started buying, lots of it. Russia was already buying. They'd been accumulating since 2014 when the sanctions started. But then Poland started buying. Singapore, India, Turkey, the Philippines. Countries that had never been major gold buyers suddenly couldn't get enough. In 2023 alone, central banks bought over 1,000 tons. That's the second highest year on record. And then 2024 happened. They bought even more. We're talking about 1,045 tons in just the first 3 quarters. The People's Bank of China added 225 tons to their reserves. But here's what nobody's talking about. That's just what they're reporting. There's strong evidence they're buying significantly more through unofficial channels. Why? Because when you're trying to de-dollarize your economy, when you're trying to create an alternative to the dollar-based system, you don't announce every purchase. You accumulate quietly. The BRICS nations just expanded. Saudi Arabia is now in conversations. The UAE joined. Egypt, Ethiopia, Iran. These aren't small players. Saudi Arabia alone controls the petrodollar system, or they did. Because here's what's happening behind the scenes. The Saudis are now accepting yuan for oil sales to China. They're discussing a gold-backed trade settlement system. The 50-year petrodollar agreement that Nixon set up in 1974, it expired in June 2024. Nobody made a big deal about it in the media, but the implications are staggering. Let me paint you a picture of what this means. Since 1974, every country that wanted to buy oil had to hold dollars. That created automatic demand for U.S. Treasury bonds. It meant the Federal Reserve could print unlimited money because there was always a buyer. It meant the United States could run massive deficits without consequences. That system is breaking down right now. And when that system breaks down, all those dollars that were locked up in the oil trade, they come home. That's inflation on a scale we haven't seen since the 1970s. But it's not just the geopolitics. Look at the technical picture. Gold broke out of a 4-year consolidation pattern in March 2024. It took out $2,200, then $2,400, then $2,800. Each level that was supposed to be resistance just got obliterated. And here's the key. Every single pullback got bought immediately. In August, gold dropped from $20,500 to $2,350. Everyone thought the rally was over. It was back at $2,500 within 2 weeks. In September, same thing. Every dip got bought. You know what that tells me? There's real demand underneath this market. This isn't speculation. This isn't retail traders chasing momentum. This is institutional accumulation. This is central banks. This is family offices. This is sovereign wealth funds. These are the players who don't care about $50 moves. They're thinking in decades. Now, let me tell you about the supply side, because this is where it gets really interesting. Global gold production peaked in 2018 at about 3,300 tons per year. Since then, it's been flat to declining. The easy gold has been mined. The ore grades are getting lower. It takes longer to bring new mines online. We're talking 10 to 15 years from discovery to production, and the capital costs have exploded. It used to cost $300 per ounce to pull gold out of the ground. Now it's $1,200 to $1,400 for many operations. Meanwhile, demand is accelerating. Central banks are buying 1,000 plus tons per year. That's 30% of annual mine supply right there. Jewelry demand in India and China, that's another 2,000 tons. Industrial use, electronics, medical devices, aerospace, that's 300 tons and growing. And then you have investment demand. ETFs, bars, coins. In 2024, gold ETFs saw inflows of over $20 billion. That's after 3 years of outflows. Here's the math that should terrify anyone who's not positioned. Annual mine supply is 3,300 tons. Annual demand is pushing 5,000 tons. Where's the difference coming from? Recycling and central bank sales. But central banks aren't selling anymore. They're buying. So it's all coming from recycling. And there's only so much recycling that can happen. At some point, the physical market breaks. And we're seeing signs of that stress right now. The premium for physical gold in China has been running at $30 to $50 per ounce above the London spot price. That's massive. It means there's not enough physical gold flowing into China to meet demand. The Shanghai Gold Exchange is draining inventory. The COMEX warehouse stocks are at multi-year lows. In November, COMEX gold inventories dropped by 2.3 million ounces in a single month. That's 71 tons, just gone. You want to know what's really happening? The paper market is losing control. For decades, the price of gold was set by futures contracts on the COMEX. These are paper contracts, promises to deliver gold. But here's the dirty secret. Most of those contracts never result in physical delivery. They're cash settled. Traders just roll them forward or close them out for cash. The ratio of paper gold to physical gold has been estimated at anywhere from 100.1 to 250.1. That means for every ounce of physical gold, there are 100 to 250 ounces of paper claims. That works fine as long as nobody asks for delivery. But what happens when central banks start asking for delivery? What happens when sovereign wealth funds want physical metal, not paper promises? The system breaks. And we're watching it break in slow motion. Let me tell you a story about 2011, because there are parallels here. In 2011, gold hit $1,900. Everyone thought it was going to $2,500, maybe $3,000. And then it didn't. It topped out and spent the next 4 years declining, bottoming at $1,050 in December 2015. You know why? Because the Federal Reserve started talking about tapering QE. The dollar strengthened. Real interest rates went positive. And most importantly, central banks weren't buying. In fact, some were selling. But this time is different. And I know everyone says, this time is different, and it never is. But hear me out. In 2011, the Fed was still credible. People believed they could control inflation. People believed the dollar was safe. The Treasury market was stable. There was no serious alternative to the dollar system. None of that is true today. The Fed has lost credibility. They told us inflation was transitory. They were wrong. They told us they could engineer a soft landing. Jury's still out, but it's not looking good. The Treasury market is showing stress. Yields are volatile, auctions are weak, foreign buyers are stepping back. China has been a net seller of treasuries for 2 years straight. Japan is selling to defend the yen. Who's buying? The Fed. Through quantitative easing that they won't call quantitative easing. And here's the kicker. Real interest rates are still negative when you measure them honestly. The Fed funds rate is 4.5%. But real inflation, not the CPI, but actual cost of living increases, is running at 6% to 8% for most Americans. That's negative real rates, and negative real rates are rocket fuel for gold. Now, I want to talk about something that most people don't understand. The difference between gold as an investment and gold as insurance. When you buy stocks, you're making an investment. You're betting that a company will grow, will generate profits, will create value. When you buy bonds, you're lending money and expecting to get paid back with interest. Those are investments. Gold is different. Gold is insurance against the system breaking. It's insurance against currency debasement. It's insurance against geopolitical chaos. It's insurance against the financial system seizing up. And here's the thing about insurance. You don't buy it after the house is on fire. You buy it when things seem fine, when the risk seems distant, when everyone else thinks you're paranoid. Right now, we're in that window. Things seem okay on the surface. The stock market is near all-time highs. Unemployment is low. GDP growth is positive, but underneath, the cracks are spreading. The deficit is $2 trillion per year. The debt is $36 trillion and accelerating. The interest on that debt is now over $1 trillion annually, more than we spend on defense. The Treasury is issuing debt at a pace that's unprecedented outside of wartime. And the Fed is trapped. If they raise rates to fight inflation, they crash the economy and the bond market. If they cut rates, inflation comes roaring back. This is the endgame of a 50-year experiment in fiat currency. And gold is telling us that the experiment is failing. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without tax penalties, how the custodian system works, what the fees look like. It's worth checking out if you're thinking about protecting a portion of your retirement savings. No pressure, just information. Anyway, back to what's happening in the next 3 days. December 20th is significant for several reasons. First, it's the end of the tax loss selling season. Any investors who were sitting on losses and wanted to harvest them for tax purposes, that's done by December 20th in most jurisdictions. After that, the selling pressure lifts. Second, it's when institutional money managers finalize their year-end positions. They've spent December window dressing their portfolios, making sure they own the right stocks for their quarterly letters to clients. But once that's done, they start positioning for January. And January, as I mentioned, is historically gold's strongest month. The average return for gold in January over the past 20 years is 2.8%. That might not sound like much, but on a $4,300 base, that's $120. And in a trending market, those averages get exceeded. Third, there's a technical setup that's extremely bullish. Gold is consolidating right below $4,350. That level has been resistance for the past week. But the consolidation is tight. It's not breaking down, it's coiling. Volume is declining, which means sellers are exhausted. And the moving averages are all aligned bullishly. The 50-day is above the 200-day. The 20-day is above the 50-day. Price is above all of them. This is a textbook bull market structure. When gold breaks $4,350, the next resistance level is $4,500. And there's not much between $4,500 and $5,000. That's a 15% move from current levels. In a normal market, that would take months. But gold isn't in a normal market right now. When gold trends, it trends hard. In 1979, gold went from $200 to $850 in 18 months. That's a 325% move. In 2020, gold went from $1,450 to $2,070 in 6 months. That's a 43% move. We're in the early stages of a move that could be even bigger. Let me tell you about the smart money positioning because this is fascinating. The Commitment of Traders report, this is data from the CFTC that shows who's long and who's short in the futures market. It's showing something remarkable. The commercial traders, The big banks and institutions that typically short gold to hedge their physical positions, they've been covering shorts aggressively. Their net short position is at the lowest level in 2 years. That means they're not fighting this rally. They're accepting it. Meanwhile, the large speculators, the hedge funds and CTAs, they're net long, but not excessively so. Their positioning is only at the 60th percentile of the past 5 years. That means there's still room for them to add. When they really pile in, when positioning gets to the 90th percentile, that's when you get the parabolic moves. And then there's the options market. Call option volume on gold has been exploding. The $5,000 strike calls for June 2025 have massive open interest. Somebody is betting big that gold hits $5,000 by mid-year. And it's not retail traders. Retail doesn't have the capital to move options markets like this. This is institutional money laying down serious bets. Now, let's talk about what happens if I'm wrong. What's the bear case? The bear case is that the Fed somehow threads the needle. They get inflation back to 2% without crashing the economy. The dollar strengthens. Real interest rates go positive. The geopolitical tensions ease. China and the U.S. make a trade deal. Russia and Ukraine reach a peace agreement. The Middle East calms down. Central banks stop buying gold. And the technical breakout fails, gold rolls over, and we go back to $3,500. Could that happen? Sure. Anything could happen. But let me ask you this. What's the probability? The Fed has never successfully engineered a soft landing when inflation was this high. Never. The historical record is 0 for 11. The dollar is losing its reserve status in slow motion. That's a multi-decade trend that doesn't reverse because of one good jobs report. The geopolitical situation is getting worse, not better. China just did military drills around Taiwan. Russia is escalating in Ukraine. The Middle East is a powder keg. And central banks have been buying gold for 14 consecutive years. That's not a trend that reverses easily. So yeah, I could be wrong. But the risk-reward here is so skewed to the upside that even if I'm only 60% right, it's still the right bet. Let me tell you about a guy I know. I'll call him Robert. Robert is 68 years old. He worked his whole life as an engineer, saved diligently, put everything in a 401k, mostly in a target date fund. By 2021, he had $1.2 million. He was planning to retire in 2023. Then inflation hit. His portfolio dropped 18% in 2022. He delayed retirement, kept working. The portfolio recovered in 2023, but his purchasing power didn't. The house he was planning to buy in retirement, it went from $400,000 to $650,000. The healthcare costs he was budgeting for, up 30%. His $1.2 million doesn't buy what it used to. Robert came to me in early 2024 and asked what he should do. I told him the same thing I'm telling you. You need insurance. You need an asset that holds its value when currencies lose theirs. He moved 20% of his portfolio into gold. That was when gold was at $2,100. Today, that position is up 105%. It's the only part of his portfolio that's kept pace with real inflation, and now he's asking if he should add more. Here's what I told him. The time to buy insurance is before you need it. And we're running out of time. Because here's what's coming in 2025. The U.S. has to refinance $9 trillion in debt. That's debt that was issued at low rates during the pandemic that's now maturing. It has to be rolled over at current rates, which are 3% to 4% higher. That's an extra $270 billion to $360 billion in annual interest expense. Where's that money coming from? Either taxes go up, spending gets cut, or the Fed prints it. Taxes aren't going up in an election year. Spending isn't getting cut. It never does. So the Fed prints it. And when the Fed prints money, gold goes up. The European Central Bank is in even worse shape. They're dealing with a recession, an energy crisis, and a banking system that's loaded with sovereign debt from countries like Italy and Greece that are basically insolvent. The ECB is going to have to choose between saving the banks and defending the euro. They'll choose the banks. They always do. And when they do, the euro weakens, and gold in euro terms goes parabolic. Japan is the most interesting case. They've been fighting deflation for 30 years. They've kept interest rates at 0 or negative. They've bought so many government bonds that the Bank of Japan now owns over 50% of the entire Japanese government bond market. They're trapped. If they raise rates, the government goes bankrupt. The interest expense becomes unpayable. If they keep rates at zero, the yen collapses. They're trying to thread this impossible needle, and it's not working. The yen has lost 30% of its value against the dollar in the past 3 years. And gold in yen terms? It's up 120%. This is the global picture. Every major central bank is trapped. Every major currency is being debased. And gold is the only asset that has no counterparty risk, that can't be printed, that has held its value for 5,000 years. Now, let's talk about the next 3 days specifically. What am I watching? First, I'm watching the dollar index. It's at 107 right now, which is elevated. If the dollar starts to weaken, and I think it will as we head into year-end, that's going to be a tailwind for gold. Second, I'm watching the Treasury market. The 10-year yield is at 4.4%. If that starts to rise, it means the bond market is losing confidence in the Fed's ability to control inflation. That's bullish for gold. Third, I'm watching the COMEX inventory data. If we see another big drawdown, that's a sign that the physical shortage is getting worse. But most importantly, I'm watching the price action. If gold can close above $4,350 in the next 3 days, that's a breakout. And breakouts in gold tend to run. The target on a breakout from this consolidation pattern is $4,650. That's a measured move based on the width of the pattern. But in a strong trend, measured moves get exceeded. We could see $4,800 or $5,000 by February. And here's the thing that keeps me up at night. What if this isn't just a bull market? What if this is the beginning of a monetary reset? What if we're watching the end of the dollar standard in real time? Because that's what the central bank buying suggests. That's what the BRICS expansion suggests. That's what the breakdown of the petrodollar suggests. If that's what's happening, then $5,000 gold isn't the top. It's the beginning. In a true monetary reset, gold could go to $10,000, $15,000, maybe higher. I'm not saying that's going to happen. I'm saying it's possible. And the fact that it's possible means you need to be positioned. Let me give you another historical parallel. In 1971, Nixon closed the gold window. He ended the convertibility of dollars into gold. At the time, gold was $35 per ounce. Over the next 9 years, gold went to $850. That's a 24x move. Now, I'm not saying gold is going to 24x from here, but even a 2x or 3x move from current levels would be life-changing for anyone who's positioned. And here's the beautiful thing about gold. It's not a binary bet. It's not like buying a stock that could go to zero. Gold has intrinsic value. It's been money for thousands of years. Even if I'm completely wrong about the monetary reset, even if gold just sits at $4,300 for the next 5 years, you haven't lost anything in real terms. You've preserved your purchasing power. That's the floor. The upside is potentially unlimited. So when I say the cheap gold era ends in 3 days, here's what I mean. We're at a pivot point. The technical setup is bullish. The fundamental backdrop is bullish. The sentiment is shifting from skepticism to acceptance. The smart money is positioned, and the catalysts are lining up. After December 20th, the path of least resistance is higher, maybe a lot higher. You can wait and see what happens. You can wait for a pullback. You can wait for confirmation. But here's the thing about waiting. By the time everyone agrees that gold is going higher, it's already at $5,000. By the time it's safe and obvious, the opportunity is gone. The time to act is when it's uncomfortable, when you're not sure, when it feels like you might be early. Because being early and being wrong look the same for a while. But being early means you get the whole move. Being late means you're chasing. And chasing in a parabolic market is how you lose money. I'm not telling you to bet the farm. I'm not telling you to go all in. I'm telling you to look at the evidence, look at the setup, and ask yourself, what's the risk of being wrong versus the risk of missing this? If you allocate 10% or 20% of your portfolio to gold, and I'm wrong, you've underperformed by a few percentage points. If you don't allocate anything and I'm right, you've missed one of the biggest wealth transfers in modern history, the cheap gold era, the era where you could buy gold at $2,000, $3,000, even $4,000. That era is ending. Not because I say so, but because the market is saying so. The central banks are saying so. The technicals are saying so. And in 3 days, when the calendar flips and the institutional money starts flowing and the breakout happens, we're going to look back at $4,300 gold the same way we look back at $300 gold in 2002 or $1,000 gold in 2009. We're going to wonder why it was so obvious and why so few people acted. Don't be one of the people who looks back with regret. The window is closing. 3 days. That's all we have left.